Everyone who's saying that is definitely like a neckbeard curmudgeon who's, oh, people who trade perp equities on perps are like people who care about tax optimization. Yeah, sure. I'm sure that's like some subset. That's definitely not going to be the initial user base at all, right? They're not going to be the ones who care about exactly how you compound dividend.
Not a dividend.
It's a tale of two quants.
Now, your losses are on someone else's balance sheet.
Generally speaking, airdrops are kind of pointless anyways.
Some unnamed trading firms who are very involved.
Alec.eth is the ultimate Ponzi.
DeFi protocols are the antidote to this problem.
Hello, everybody. Welcome to the Chopping Block. Every couple of weeks, the four of us get together and give the industry insider's perspective on the crypto topics of the day. So quick intro is first you got Tom, the DeFi maven and master of memes.
Hello, everyone.
Next, we got Tarun, the Giga Brain and Grand Poobah at Gauntlet.
Yo.
Joining us today, we've got special guest Kaledora, Empress of RWAs at Ostium.
Thanks for having me. Hey.
Your alliterations are getting worse, Haseeb. You used to make sure all of these titles had alliteration.
Empress of RWA. I thought that was pretty good. It's like
that sounds
like
pretty good.
a half rhyme.
It's a catchy name.
It used to be alliterative, though. You've kind of like...
It is alliterative. Empress of RWAs at Ostium. It's like an Emily Dickinson. It's like a half alliteration kind of thing.
Yeah.
All right. Give it to me. Give it to me. Give it to me. All right, fine.
It's alliterative.
You can write these from now on if you want.
It's musical.
Yeah.
You can write these from now on.
I'll give you that.
Okay. All right. Rhythmic, you say. All right. Well, I'm Haseeb, the head hype man of Dragonfly. We're early stage investors in crypto, but I want to caveat that nothing we say here is investment advice, legal advice, or even life advice. Please see choppingblock.xyz for more disclosures. So, Kaledora, you just got off being the main character of crypto Twitter for about a day. You got pushed through the washing machine of everybody on the internet getting mad at you. How was that? Tell us about.
It was an experience. It was my first time being, I would say, experiencing a public flogging. So I can recommend going through experience at least once. It was definitely informative. I mean, look, my main takeaway was thank you to the haters because it drove more attention to us than we've ever had. So overall, I think I was surprised, I think, by how people are able to misinterpret things or interpret things in a way that you totally did not anticipate. So any potential lack of clarity on a topic that is likely to elicit strong opinions will likely be misinterpreted by some subset of the people who are reading it. So that was an important learning. But overall, I mean, look, I think it generated a very interesting discussion, and I'm just happy to see people talking about the topic because we've been thinking about it for a long time, and it's great to see it finally, I think, getting sort of mainstream attention. So even if some of that is negative, it's actually wound up being very good for us, and we've seen now all-time high volumes in stocks and indices this week. So all's well that ends well.
Every cycle, there's always one community that is like the roving bandits who just like murder everybody in their way. This cycle, it's the .HLs. In the past, I remember actually the show got assaulted by the Cardano guys a while back. I don't know if you remember that.
Interesting. Okay.
I think both you and I had run-ins with the Cardano crew. Back in the day, it used to be
Link
Chainlink
Marines.
Guys.
Yeah.
I was gonna tweet this, but I was like, I'm gonna make so many more enemies if I say this. But I guess I'll say it now. The .HLs of the new Link Marines was my first thought. But yeah, it's good. People are passionate.
They're very passionate. They're very passionate. But it did lead to a very interesting conversation at a reading level that I usually don't expect from CT these days. I think I even got Jez to like write a paper about the convergence of funding rates to pay out dividends and da. So we should talk about what we're talking about for the audience that isn't quite as brain damaged as we are. So Ostium, which is the protocol that you're building, is a on-chain perps on RWAs. Now, what does that mean? These are derivatives. They're Delta One derivatives. They track the underlying price of RWAs, meaning real-world assets. So things like the NASDAQ, gold, named stocks, right? So like Tesla stock or whatever, you can trade derivatives of those things using Ostium. And your claim, and the thing that got CT up in arms, is that so what Hyperliquid is doing, or rather what Unit, which is a protocol built on top of Hyperliquid, they're one of the first HIP-3 markets on Hyperliquid. They launched a product recently called Trade.xyz. And Trade.xyz, right now, it's got capped open interest, so the market is not kind of fully open quite yet, but people are going on there trading the first popular product, which is basically, I believe it's the NASDAQ, right? And the NASDAQ market on there has a pretty large funding rate for what you would normally think is probably an extremely liquid and very easy to hedge market. And so I think it was paying you. So you snapshotted it.
I snapshotted it at one point in time, and I think some people's gripes was that it was a very narrow point in time and it didn't reflect the sort of like average funding rate. But my point was more about the magnitude of the rate. At the time when I snapshotted it, it was 365%. So people were up in arms because for several reasons. One, because they misinterpreted the post in the direction of the payment, but two, because they felt that it was an unfair claim that the funding rates being so high was an indication of market structure failure in some sense. And my claim was that from a user experience perspective, having such extremely volatile funding rates that can either can reach 365% in one direction or the other is detrimental to the user experience, because the result is you as a user, you typically want to be, unless you're running an arbitrage strategy, which is very different. But if we're talking about sort of the average retail user, which is really what people have, this is sort of the broader vision for equity perps. Like the narrative right now, and I'm fully bought into that. We've been on this for a long time, is that there's a massive opportunity in basically expanding this sort of perp or perp-like instrument to sort of the general audience, especially on assets like stocks that people, if they want leverage, they're typically trading it through options, which are a much more complicated instrument to understand. But that the whole premise that this is based on is like, this is a it's a linear instrument. It's easier to understand, and you're not trading. There's fewer extrinsic sort of like market specific variables that you have to track, or like instrument specific variables that you have to track, rather than just tracking sort of like the directionality of the price. But the fact is that assumption or belief completely erodes and actually winds up not being true if you as a trader might be subject to funding rates that could wildly swing in one direction or another, that are orders of magnitude larger than what the average price change would be of the asset over the course of that year. And so as a result, the thing that actually impacts your P&L winds up being more so the funding rates. So the payments between the sides wind up impacting your P&L more than the actual change in price of the asset, which sort of like gets to the very heart of what actually the whole premise is around why people would want to trade these instruments. So that was my broader point. And yeah, I took the screenshot at like I wasn't like tracking the number and then screenshotting at the right time. I just like went onto the page, saw the number, and I'd been looking at it periodically over the course of the day, and I screenshot at that time. But yes, it was quite high at the time. And loans are getting
so I want to get into the wonkish side of this debate about the structure, like what's the right structure for which perps should come on chain. But I also want to give a little bit of background for the audience who might not follow all the details here. So I'm gonna try to see if I can get them caught up. So the big story that we've been talking about off and on the show has been that perpetuals, which is the primary way that crypto derivatives get traded, are actually a really well-suited instrument to trade a lot of different stuff. And many people want to bring perps to equities. So, Robinhood very famously is trying to do this. Coinbase has talked about this. And many people have talked about, hey, can we get this instrument that trades so much volume in crypto to generalize to other assets? Now, many people think this is one of the largest opportunities that exists in crypto. And if you want to get equities on chain, one way to get equities tradable on chain is to tokenize them, get the actual physical equities, put them in a box, put them on the blockchain. But a much faster way to do it is to just create derivatives. And of course, derivatives trade much more than spot in crypto and in every asset class. So the natural way this is done with perps, and this is the thing you're pointing to, is that in a perp, when there are more people who want to be short than long, then people who are short have to pay the people who are long. And they might have to pay them a lot of money if there's not enough people willing to go long. And what you're pointing out is that they were going to have to pay them, if the funding rate did not normalize, which obviously it fluctuates a lot, they would have to pay them 300% a year in order to hold this position for a year, basically, this like massive carry. Now, the number's been fluctuating. Last I saw, it was like between 15 to 20% or something like that. There's still open interest caps. So one would assume as the market matures that number's going to go down, given that it's like really easy to hedge the NASDAQ. But there's still, meaningful funding rate. And crypto at various times has had funding rates go up and down to varying degrees. So hopefully that's some exposition of why there's so much debate about, okay, does it really make sense to have a venue to trade these things where you're having to pay like, even let's say not 300% a year, but like 15% a year to hold these positions? Because of course, a lot of people invest in the NASDAQ, not because they're YOLOing. I mean, some people are YOLOing the NASDAQ, but a lot of people are buying the NASDAQ because they're like, yeah, I want to invest in the NASDAQ for the long run, but the NASDAQ doesn't go up, more than 15% a year on average. So it kind of, if that's actually what if the funding rate is actually causing longs to pay shorts, then it's kind of a moot point to hold a position long term. Now, many people don't use perps to trade long term. So many of the counter arguments like, well, no, these are really short term derivatives to get leverage and do like a short-term trade. These are not positions you should have open for a year. So I'm going to pause there. Tarun, want to get your take on this whole debate about whether or not perps are well suited to trade equities and other RWA type instruments.
I mean, I guess I think all derivatives have some funding costs, right? Like if you're trading options, you want to pay you have an annualized option, you're going to be paying the roll costs of rolling each expiry. I think, obviously continuously priced things are maybe harder to deal with than options, where it's like, it does feel like a lottery ticket. Actually, when Jeff was on TCB, I think like a few months ago, maybe like 6 months ago, we kind of had this debate, right? Where he was like, oh yeah, everyone wants perps for equities. Like it's completely obvious. And I was like, well, some people like lottery tickets because they don't have to think about them. They just throw the money in and then they don't think about it unless they win, right? Like they don't have to think about liquidation price. They don't have to think about their payoff changing. Their payoff is either zero or whatever the lottery ticket is. And in equities, for some reason, that's like systematically built in. I don't think all these debates about the dividends are annoying to compound and include are useful. Like everyone who's saying that is definitely like a neckbeard curmudgeon who's like, oh, like people who trade perp equities on perps are like people who care about tax optimization. Like, yeah, sure. I'm sure that's like some subset. That's definitely not going to be the initial user base at all, right? They're not going to be the ones who care about exactly how you compound dividends. Like they want 10x long Tesla. Like that dividend is like 25% of that, right? Like I doubt they even care at all. But I guess like collateral management's a lot more annoying with RWA perps. Obviously, you have to like think about collateral in and out. Also, it's not clear that a lot of the systematic things in crypto that people take as truisms, like basis trades are particularly in contango in a certain way, like it is with Bitcoin, is like going to be true for equities, right? Like I don't think we have enough volume to really know whether you kind of, it could be a funny thing, but it may turn out that like equity perps just have some weird properties where due to their, the fact that like during market hours, they're sort of like a linear delta one product, like that tracks the spot thing, but like after hours, they're more like some weird futures market on the next day's opening price that funding flips overnight to the opposite sign that it is during the day. And like there's like lots of weird idiosyncrasies that I have no clue how they will change. And obviously how you choose the oracle and all these things, it impacts that. So I guess I don't know. I don't see a reason to be like, oh, we should kill this thing before anyone even tries. But I also just sort of think it's much more likely you're going to be more successful at getting these right if you've had to do collateral management for for like the crypto assets first, and then figure out the lessons learned from the crypto assets, and then specialize to these kind of assets with way more covenants than the other way around. Because I just think crypto collateral management is kind of just its own beast, and all of these things are going to be margined against that, at least in the beginning. I don't.
But I mean, one thing that we have learned is that crypto is really simple compared to these real world assets, right? There's no dividends, there's no weekend versus daytime.
So you're talking about this 365% funding rate on October 10th on multiple centralized exchanges. Solana was at minus 200% because someone blew out. No one was market making, and like no one was taking the other side for like 6 to 7 hours. So like these things do happen in even the continuous assets in these kind of like really bad event times. It's just that in the equities case, they happen more frequently than the kind of crypto version. I think it's just this. There's kind of this belief that perps or delta one is also a little bit of a lie, because like the funding rate process need not be this thing that's like mean zero and very small at all. Like it can have these kind of huge blowups that suddenly make you look like you had this kind of option smile exposure, this tail risk exposure. So yeah, I guess it's more like people should just run the experiments. I don't know why we have to like neckbeard before people play around with the market. It just seems like too much like intelligent
I thought that was
design by
literally your
them.
job, is to like neckbeard stuff before
Yeah,
we,
but
we
the perp
end up making things blow up.
the equity perps thing is like, I just need to see the demand first, right? Like it's like it first needs to just like have users that are like a lot of them, like before we can make any, you know, kind of claims, in my opinion.
So I have a lot of thoughts. I mean, my first comment would be, I mean, I'm totally on the same page. Like, we 100% should be running this experiment, and the markets are only going to get, I mean, I'm vastly a proponent of different implementations, people trying different stuff, and we have a very different approach, and it's great. It makes everybody more competitive. You want different competitive products in the markets, and there'll be different approaches, and some will work and some will work less than others. My my comment on sort of funding rates was more as it relates to what it'll do for demand, and I think that's also what pissed people off the most about the post, because you just mentioned you first want to see what the demand is, and what we found, the reason, so we moved away from a model that had funding rates to, and we can talk more about this, you actually made a post about this, Haseeb, afterwards, which is, you were asking like why were equity perps better than CFDs for some of these assets. And our liquidity model, we need to find actually a better name to describe it. I think some of our problem is that we need a better nomenclature. So that's in the works. But our model is somewhat of a mix between a perp and a CFD. There's a lot in the liquidity model that's actually more akin to a CFD, just put on chain and made more transparent. And
Sorry, Kaledora, can you explain what a CFD is and the difference with a perp?
sure. So a CFD is a contract for difference, and CFDs do trillions in notional volume a month outside the US. They're like the largest retail derivatives market for TradFi assets. They effectively are, besides like some other markets on FX outside the US. They are the primary way that people trade derivatives outside, beyond the US and India, where options are the largest retail derivatives market. Besides those two geographies, CFDs are the largest instrument, most widely used instrument. And my general view, I think that actually reflects something very important about demand. Like, people want to trade the simpler instrument if they can. And maybe my quippy way of describing that same phenomenon in crypto is like, given the option between options and perps, like people pick perps. Perps are a far larger market. They're like nearly 100 times larger in crypto than options. And you see similarly, like in any market where people have the choice between, like retail has a choice between using options and using a CFD, they pick a CFD. For those who are unfamiliar with like how it works, like CFDs are very similar to perps in a lot of ways. They don't expire. They allow you to go long or short easily. They're fully synthetic, so you can't redeem them for the underlying. And they are sort of a linear instrument, maybe absent the sort of funding rate discussion. They're a linear instrument. And the difference is they don't have a free floating mark price. They don't have these sort of natural market dynamics the way that you have in like a proper perp on an order book exchange. The way I would think about it is, if you're an online trading platform in the Philippines and you want to offer, your people, your guys want to trade the NASDAQ, you're not going to try to recreate your own native exchange and native order book for that. You're instead going to go and pull pricing from the most liquid market. And there are thousands of retail brokers around the world, and they're not each going to create their own. It's this funny. I think it is a strange phenomenon in crypto, because I suppose like a Binance is both like a retail facing, like a consumer facing platform, and an exchange where those markets are made. But that's actually not the case. And I would actually bet, if I would bet on a strong thesis that, like, I think the disaggregation between like the exchange layer and the more front facing, there's like the extreme end of the front facing, which is like you're just a front end, you're routing trade somewhere else. There's something that's a little bit more in the middle where you have some control over liquidity. You do aggregate liquidity in some way, but you don't have an order book. And there's actually the back end, like order book. I would bet I think these are going to become like much more distinct categories in crypto as the space matures, just in the same way that you've seen in the traditional markets. And yeah, there's these thousands of consumer-facing trading platforms around the world to get entry into different markets. They're not recreating their own exchanges. If people want to trade the NASDAQ, they're not trying to recreate, or Tesla, they're not recreating their own exchange for Tesla. It's even a Robinhood, right? They're going and they're routing, they're finding, Robinhood's a slightly different model, but like on one of these CFD brokers, they're going and quoting a price from the underlying market, usually with some small spread or markup on top based on their own internal pricing model. And then they're internalizing some of that flow, and then they're routing some of that flow to liquidity providers who then, aggregate that across exchanges, ultimately lay that off in the underlying market in some way through some set of intermediaries. The point that I'm making here is, we have moved away from this pure sort of traditional perp model, because, and you could make an argument that we were just too early. That's like, I'm open to that argument, but I do think like the core insight that we found was we tried to use natural market dynamics, like a funding rate, to incentivize balance between the sides, like balance and open interest. And what we found was, ironically, the same funding rate that would incentivize people to come in and hedge on the short side, because people, general the market is like skewed long, was ironically like basically the same funding rate that would completely kill the demand on the long side. So it's this terrible kind of like catch-22, like cold start problem. We tried it. Like we actually used to have funding rates, like proper funding rates on all of the traditional assets. And we moved away. We kept them, on crypto because there's a whole market for arbitraging the stuff. And like there's the market structure exists to arb that stuff out. But it doesn't exist, especially when you think about, even what it would take to run, something delta neutral and rebalance your collateral across wherever you're hedging off chain and on chain. There just isn't this infrastructure to go and hedge out these imbalances and ensure that your book isn't massively skewed. So you just wound up with like, you could have one whale, especially when the market's nascent, you could have one whale that comes in, opens a massive position on one side and completely screws it for all the other traders. And suddenly they're faced with this massive funding rate. And it's this chicken or egg problem where, and then I totally believe that over time, this stuff will get better on the large assets. The problem is as you go into the long tail, and then like, NASDAQ right now on chain is a long tail asset. It's behaving, it has the funding rate volatility and the like liquidity depth of basically like a shitcoin, because like it is relative to the amount of liquidity that's sitting around in crypto to go and market make this stuff. It's like really close to the bottom of the totem pole. But over time, it'll get better. But if you're trying to list hundreds of stocks, it's just, you're going to unfortunately wind up with a system where, as I was saying in the beginning, you're going to kill the demand ahead of time if you have these funding costs that are so variable, because no normal person, maybe some crypto people are willing to tolerate it because they're like used to it and they're not actually doing the math in their head. Like it actually does make sense in crypto when assets move like 20% in a day to maybe bear that cost. You're willing to pay for the exposure, the leverage exposure to an asset with that much volatility. That's not really the case for more traditional assets, even though recently, even gold, $30 trillion asset has been behaving, behaving like a shitcoin. But it's, yeah, you are going to wind up, you kill the demand in the first place from the sort of normie audience, which is this sort of North Star. Like normal people are going to want to trade perps on these assets instead of options. You kill the demand in the first place if you eliminate the core promise of using this sort of like Delta One instrument in the first place as a means of taking on exposure.
Okay, so let me get Tom in here. Tom, what's your take on funding rates as a dynamic in RWA perps?
I think that I always kind of comp it actually to like leverage ETFs, where you obviously also have volatility drag, but they're like insanely popular. Some of the most popular ETFs that have launched this year are like 3x leveraged single name equity ETFs. But like the point, and obviously the point also around options is like these aren't people who are like taking their retirement account and like putting it into a perp. Like I would not recommend you do that. The point is people do want to speculate with leverage on a short-term time horizon, right? Like 0DTE options, you're just trading delta, getting leverage to the delta. Those are like, what quadrupled in like the past 3 years. And so like, I think I hear people that like, hey, obviously on a long time horizon, funding rates are not attractive, but like the point is like, these are short time horizons. Like these aren't long time horizons. And I think, clearly they work in crypto where you can get spot access, and yet, perps are still gigantic. And so I guess like, I guess maybe zooming out, it's like I think the critique doesn't really make sense to me, because you can see sort of the analogies in traditional finance and in crypto where like clearly people are okay paying for this because like the type of exposure that they want is different. So like I also don't know why people are so up in arms about equities perps, because I agree like CFDs are insanely popular. Obviously some of the specifics are different between the two, but I'm like, this doesn't strike me as like so insane of an idea that like, okay, people in crypto might also want exposure. And it also seems like a more feasible path in my mind than like, yes, literally trying to tokenize actual shares of assets and put them on chain and have this access to a global audience, which is obviously just very, very difficult to do.
It just depends on what the competitive landscape looks like. If like what you're saying is true, like people hold their positions over a short period of time, like they're not, they're trading over a short time horizon if they're trading on high leverage on perps. But if there's one place where they might, if, a large trader might face like they might suddenly massively skew the book, and they have no, they don't actually know when funding rates might renormalize, and it's very unpredictable, and it's now an additional factor they've taken into account. But there's another platform where they can go, and they know they're going to face a much more predictable cost that's much lower. They will migrate there, right? So it's I think like the market structure is path dependent, and I think that's something that people tend to ignore sometimes, because like you're working with markets that already people might be also willing to pay like a premium to trade something on chain, maybe a 5x premium or a 2x premium. They're probably not willing to pay like a 20x premium. Like there is the bar for the liquidity you have to offer, and the cost that people have to pay is just a higher bar in terms of, because of the alternatives that exist. It's not the same as sort of like a DeFi Wild West. So
yeah, so I mean, this is one thing that Tarun has brought up many times, is how retail just gets destroyed on these leverage ETFs. Like the roll costs are terrible. They don't really track the underlying very well, but nevertheless they keep making them because they just sell like hotcakes. Like people love these leverage ETFs because they're just extremely simple products. And I think that, to me, that's emblematic of, I actually don't know how much the market structure stuff is going to matter so much as just the go-to-market and like the product marketing and like just getting all the the little finishes and the details right. I kind of think like the worst I think people sort of overestimate the kind of, call it, structural determinism of building products and building startups. Like it's not clear to me at all that the best product by structure or design is going to win. The reality is that, equity perps are tiny. All this stuff is tiny compared to crypto trading. And the CFD market is absolutely fucking enormous. And so if crypto can start to just take a bigger and bigger piece of that pie, probably doesn't matter that much if in the short term. I mean, maybe if people get up in arms about it and they can manage to make it something about which they raise a stink and like socialize the idea, they're like, oh, these funding rates consistently make this a bad trade because blah, 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 blah. Yeah, fine. But I more or less agree with Tom that a lot of people are coming into these trades, like they're not thinking about making 15%. Like they're thinking about either I'm going to, this is my lottery ticket out of this dump, or, it's back to wage cucking or whatever the kids call it these days. So
that is what they call it.
That is what they call it. If that's your mentality, then like who gives a shit, right? Like mostly when you're going for somewhere that like is a cool product, easy to access, easy onboarding, and like that your friends are using, and that has this kind of viral, just sort of accessibility to it. I think that feels to me much more relevant than, is the funding rate 15% or 20%, or is it like, how many market makers are arbitraging this and that. Now it could be wrong, and I do think that like, at some point people are going to come on chain not to YOLO but to actually save, and obviously there are many more savers in the NASDAQ than there are YOLOers, right? Even obviously Robinhood and zero DTE options and all this stuff. Yes, it's all been growing, but it's all still tiny compared to the people who just passively hold their money in all these instruments. And so on some level, if you're talking about trading fees, you don't make trading fees from, passive holders. But if you're talking about the AUM that comes on chain and the real kind of economic disruption, I think that also happens from savers coming on chain. And savers coming on chain is a much longer putt. And and to me, I think that's probably more about tokenization than it is about derivatives, because I don't know that you want to have a derivative position open for like, 10 years. Like that, I don't think any protocol is necessarily going to be around by the time that you want to exit your savings position. Whereas if you're trading and you're YOLOing some, like, hey, I think Trump's going to strike a great trade deal, I'm going to go 20x long the NASDAQ, then yeah, you're playing a different game.
It just depends on size too, right? Like there are like YOLO shrimps, and like you're probably right that they're not even looking at funding rate at all. But there are a lot of very high leverage traders.
If you are the market, yes. If you are the market,
if you're trading a lot of size, which there are a lot of people, like the platform is whale dominated.
That's the thing. When you have that scale of money too, you're also probably more
smarter,
economically literate. Yeah. And you're thinking a lot more about, hey, what's my carrying cost for this trade if I want to put it on for a few days.
And I can just say this from personal experience. Like we've had like hundreds of conversations with traders where, and like we changed the system specifically because of this complaint. Like after months of complaints, like people changing their behavior on the platform because of the variability of our funding rates. And we had like dozens of hours of calls with people trying to figure out what to do. So, but these are largely whales, to be fair. It's not like someone you're onboarding through TikTok.
Yeah.
In that respect.
All right. Well, speaking of whales, we're gonna switch gears a little bit and talk about one of the big stories this last week, which was the pardon of CZ. So CZ, of course, was indicted 2023. He entered into a plea agreement with the DOJ and served a 4-month jail sentence. He was basically, it's kind of a complicated story, but the Wall Street Journal actually did a great deep dive into all the back and forth that took place here. So basically what happened was that there was a lot of reporting that CZ was angling for a pardon. And CZ publicly denied that he was angling for a pardon. He said, no, and I'm not trying to get a pardon. What are you talking about? Never heard of this. Which is his thing of like, oh, this is FUD. And then it was reported that CZ decided, like, you know what? Since everyone's reporting that I'm looking for a pardon, fine, I will go ahead and publicly apply for a pardon. Mr. Trump, please pardon me. It was widely reported, of course, that MGX, which is one of the sovereign wealth funds behind the UAE, invested into Binance, the first ever investment they made into a crypto exchange. They invested $2 billion into Binance, and that investment was made entirely in USD1, which is World Liberty Financial's stablecoin. And to this day, I think Binance still holds like 90% of the USD1 still in USD1. And it's one of the largest sources of circulating supply for USD1. It was also reported that there was some assistance that Binance gave to World Liberty Financial in terms of development and some stuff they were doing together in Pakistan or something. I don't know. There's a bunch of stuff flying around about how different ways in which they work together with the World Liberty Financial team. And all of this apparently culminated in CZ receiving a pardon last week. So Trump announced the pardon, and he claimed in the pardon that he had never met CZ, but that he had heard that CZ was a good guy. And that this was a Biden era, one of these victimless crimes, whatever, blah blah blah. This part of the whole crypto witch hunt that Biden was doing, and so the crypto community largely celebrated, but this has seemingly resulted in a massive political backlash. I've been honestly somewhat surprised at how much press time this pardon is getting. But it's even now really penetrating MAGA. I think you're getting a backlash within the MAGA movement about this pardon because of the fact that, of course, it just appears to be potentially corrupt, pay to play. There's all this discussion about, hey, CZ is he's not even American. Like, he seems to have been has some financial interest with the Trump family, blah blah blah. So now, of course, all of this is these are more or less like immaterial because CZ already served his jail sentence, so he's already out. But the presumable impact of this is that there are things that one cannot do as a result of his plea agreement with the DOJ. One of those is that he could not be an officer of Binance anymore, and so he was, kind of separated aside and instead running his family office and investing and doing sort of other stuff in the wings as opposed to directly being involved with Binance. Now that he is pardoned, presumably he is able to retake the reins and become CEO of Binance if he so chooses. Now, unclear yet what he's going to do with that or what that means, but obviously this has been a pretty titanic story within the crypto industry. Tarun, what's your take? CZ getting pardoned. How do you feel about it?
I mean, I feel like I've gotten lots of angry messages from people I know who hate crypto.
You got angry messages?
Yeah.
Wait, why did you get angry messages?
Fuck you guys. How did you guys figure out how to bribe the president? I feel like I got like texts and DMs and group chats that were just like,
how did you guys? Wait, why is he roping us into this?
You guys means like anyone vaguely related to crypto was the you guys.
Wow.
So
okay.
I will say the political backlash is real. I feel like I've never gotten more random reporters emailing me. Do you have any comments on like what you think about this thing? I'm like, what the fuck is that? Like, I forgot that this happened.
I got a lot of reporters hitting me up about this.
Yeah. I did feel like I did talk to reporters, and I feel like I kind of deflated the story a little bit. Where I think you look at it and you see, if you know nothing, you're like, oh my god, $2 billion going into World Liberty Financial. And it's like, no, actually, they're using the stable coin and they're forgoing the yield. So depending on what the current short-term treasury rate, it's like, okay, maybe like 60, 80 mil that they're of yield that they could be getting, they're not getting. And so it's like this actually kind of very roundabout way to your point of like basically giving finances to this thing that is like in part owned by Trump family. But it's like I feel like this is actually like a very funny kind of thing. I've also seen like there's like a couple of European countries have this like golden visa thing, and I've seen people where they have like a Bitcoin fund that has like just holds Bitcoin, has insanely high fees, but it's like if you do this, you can get the golden visa. And so it's like very like much like a backdoor, like just give us some money because you were going to pay non-market rates or your for this like management fee, which is effectively very similar, versus like, okay, literally give somebody some money. And so I don't know how you think about opportunity cost or cost of capital as a form of bribe, but that's basically kind of what we're giving up here.
Well, to be clear, Binance doesn't like if they were holding it in Tether, they would also forgo the interest, right?
Yes.
So they would have to. The counterfactual has to be that they're holding it in cash in a bank account, which probably they have bank accounts now, but that probably once upon a time Binance didn't have bank accounts that they could hold that kind of money in.
I did try.
Maybe they're getting some off-chain rewards. We don't know the full story.
I did try debating one person who kind of really brought this into this one group chat of old friends of mine from like 15 years ago. And I was just kind of like, yeah, well, HSBC is paying like $2 billion in AML fines a year. I don't see their CEO going to jail for 6 months. but I got pilloried, and then I quickly never replied to the rest of that.
Your friends are very aggressive against you for like collective blame for what happens in the crypto industry.
Who are your friends?
Yeah.
Let's put it this way. There's a reason Zoran is winning in New York.
Okay. All right. Kaledora, what was your reaction?
Oh man, honest to God, I didn't spend too much time on it. I don't have a very strong opinion. I'm very curious to see what he does.
You think CZ should have gotten pardoned?
I'm going to decline to express a strong opinion. I really don't have a strong opinion.
Spoken like somebody who needs to get listed on Binance. Very good. I like that. Excellent.
Haseeb, the translator.
Yeah. No, I actually, I think it's an interesting case because I do think that the prosecution against CZ was kind of bullshit. Like he got 4 months, which is like what you claim that he's some criminal mastermind and that he facilitated sanctions violations and routed all this money to Hamas.
Yeah, it seemed more like a slap on the
months.
wrist in name only.
Yeah, it's like this is like a fake. Something. It's like okay, either he's a horrible criminal or he's not, right? Like there's no like what the fuck is 4 months? And the other thing, of course, that he's the only person who's ever been put in prison for a Bank Secrecy Act violation. So it was claimed that he's it was a money laundering violation. It was not a money laundering violation. It was a failure to implement an anti-money laundering program violation, which is not the same thing as money laundering. Money launderers get very different treatment. They do not get 4 months and a slap on the wrist and like a minimum security whatever camp in Seattle or whatever it was that CZ was serving his time at. So I do think it was very clear that this was a post FTX. We got, something must be done. This is something. He's Chinese. He's like the big boss guy who like Elizabeth Warren says we gotta go get them. And so they went and got them. So I do think that the prosecution of CZ and not necessarily the prosecution, but certainly the sentence was clearly unjust, right? And like, I think the same thing, largely true for Arthur Hayes, is that like, again, relative to that, Arthur Hayes didn't serve any time, but I think both of these prosecutions were obviously unjust. Now, that being said, I think the optics of Trump doing this are incredibly stupid. Like, what the fuck did he think was going to happen when you pardon the guy who like...
What did he stand to gain is my... It's not.
I don't think Trump is
$60 to $80 million in interest.
But he already got the money. That's the thing. He already got the money, right? Like, what more does he need?
Yeah. How does the pardon? Like, yeah, exactly. The pardon and that are almost completely separate, right? Like, it seemed like the pardon.
Well, I guess the answer is you keep the money in USD1, right? So, like, obviously you can redeem.
It does feel. I agree. The optics were really bad, but then I'm like, what? I don't know what the standard is. Like, if you bank with Chase and they also pay you nothing in interest, are you bribing Jamie Dimon? Like, I don't like, you could run the exact same playbook, but
nobody who's holding $2 billion with Jamie Dimon
to be fair, yeah, it's also like there's not just like one.
Just stick it in the Chase savings account. You're earning 0.01%. There's a free 80 mil for Jamie.
No, but as a percentage of your market cap of your float, no one is giving a bank CEO that much in interest.
Also, yeah, the bank CEO doesn't make that much of the margin of JP Morgan,
exactly.
Right? So
I was, it's being donated to JP Morgan Chase's top line. The joke.
It's being donated to the evil building.
Yeah, look, I don't know. I don't know what the right answer is here. For one, like, I think doing this in the middle of your administration is just incredibly stupid. Like, especially going into the midterms. I think this is now, like, I think this is actually quite bad for crypto because this has really animated people in a way that I was not expecting. I kind of thought like, okay, it's another Trump scandal, whatever. But like, this is still front page news. It's been like a week, and like, there's Wall Street Journal is running like a full page spread on it right now.
It's even going to reach the retirement homes, because I heard there's like a 60 minutes like long form special.
Oh no!
Yes, yes. There's a 60 minutes that's coming on this as well.
So I don't think I doxed anything, but yeah, I guess there's
they've been talking to a ton of people. The people have been getting the word. So yeah, this is definitely going to play in the midterms, and I think this does hurt crypto and its credibility. So
do you really think this will play in the midterms? You think people care?
100%.
I mean, you think they're going to play out the interesting? Okay.
Yeah. I mean, this is
maybe
just
I have different friends. I don't know.
So Tarun's got friends who are pillaring him and collectively blaming him for the sins of the industry. Your friends are just like,
but
whatever.
This has been true for a long time.
Complete silence. Not one friend has brought this up to me. So I don't know. I must have a very
maybe you're just ostracized from because you're in New York, right?
Yeah.
Yeah. Are your friends pretty liberal?
Not really, to be honest. Yeah, I've met a lot of pretty most of my friends are like pretty libertarian tech friends. So that's probably why.
Maybe they're fine with it then.
I think I agree. It looks worse for crypto. Like, I don't think any Trump voters are like, oh, well, this is the final straw. Him pardoning, CZ, that's actually the thing that's not going to make me vote Republican or vote for Trump anymore. But like, I think to your point, we felt like the industry had this tailwinds, things were getting more legitimized, more buttoned up. And then it's like, oh, this is kind of a pointless detour, versus kind of the all the other headlines that we were getting, which I think were quite good.
Yeah, I think add that to like the meme coin and like all the other, it's just like the parade of kind of bad optics just doesn't stop. So I don't know. I'm hoping that this news cycle does end, because like, again, I assume that for CZ, like this, I mean, it's nice to have a pardon, and like, when you're worth that amount of money, whatever, 60, 80 million, whatever, is like not a big deal to pay for like getting your name cleared. But so I wouldn't fault CZ if in fact that was the master plan from the beginning. But it's just like such a headache for the rest of the industry now that have to deal with this, because it's just stupid. Okay, so moving on, the other big news that we had over the last week was it's seemingly M&A season. And one of the big M&A stories was around the platform called Echo. So Echo, of course, is a crowd sale platform, and it was founded by Kobe, who's one of the beloved traders in crypto Twitter. And Kobe, so it's used for ICOs and or syndicates that you can follow a syndicate into investing into a pre-launch investment into a token. And Coinbase announced very recently they're acquiring Echo for $375 million, combination of cash and Coinbase stock, closing in Q4. Alongside that, they also bought the $25 million up-only NFT. This is an NFT that Kobe created seemingly as a joke, claiming that if anybody bought this NFT at an absurd listing price, that the buyer would be eligible to commission one extra season of the Up Only podcast. And so seemingly as a publicity stunt, Coinbase bought the NFT the day before they announced the acquisition. I'm assuming that this is part of the acquisition price, not actually that they paid $400 million, but obviously very, very, very good marketing stunt, got the entire internet excited. But actually a pretty massive outcome, of course, for Kobe, but also a very interesting deal in them acquiring an ICO platform and seemingly putting their sights on capital formation and going earlier in the token generation pipeline and, kind of playing a little bit in our lane, gentlemen. Thoughts on the Kobe acquisition?
Do you consider CoinList a competitor to VCs?
Yeah, I'm not worried.
I mean, they do.
Like what? I don't think.
They say they are. I mean, do you not agree? That's certainly the rhetoric.
Yeah, definitely not. Yeah.
I don't know, when you walk down, the street and you see, world's best coffee in the store sign. Do you also believe it's the world's best coffee?
Do you believe that the 500 number one Chinese restaurants are number one?
Yes, they're all number one.
They're all number one.
I do think it seems like, I agree. They're just trying to go more full stack, and you see Coinbase doing this with more and more companies. They also bought Liquidity, which was a portfolio company for us, which does like token distribution and investing. So it's sort of like this full token lifecycle. Kraken obviously doing this partnership with Legion, so they also have their kind of own play in the token launch platform world. Part of this also just seems like a bet on more aggressive token issuance clarity or something like it passing, more types of companies issuing more different types of tokens beyond kind of what we've seen historically. And also just, I think that the most interesting thing with Echo seems like it's kind of gotten over a lot of this adverse selection issue that you normally see with crowdfunding platforms, where they have actually had, a lot of decent wins early on in the life of the platform. Whereas like you go on, the vast majority of crypto or non-crypto crowdfunding sites, and it's always just like garbage, and the performance has always been bad. And maybe Echo just
Wait, you're telling
has
me
that kind of sheen to it.
You're telling me that the 500 billion OpenAI SPV that's charging me a 7% management fee is a bad idea? Damn.
Well, it's that, or some sort of Juicero type startup. Those are really your two options when it comes to crowdfunding platforms. But I don't know. Maybe there's also again banking that we're going to see 10 times more crowd sales in the future.
Yeah, I mean, look, obviously Echo right now is the premier one. Legion is sort of second, and then there's whatever, just kind of a graveyard of other ones that don't really matter. What's interesting is that, like, if it's very feast or famine, I think is the right way to understand these platforms, which is that most sales on Echo do not sell out. Like the demand is not clear, the market, like there's still tokens left over. And then there are the blockbuster ones, the mega ETHs or the plasmas, and they just go like crazy. It's just, completely oversubscribed. And there are very few deals that actually end up doing well. Those are two of the ones that have done very well off of Echo. But it's like there's a little bit of almost like a fantasy that's being sold to founders that this is like the solve for capital formation, that like you're going to be able to raise money using these things, even if nobody else, like the VCs don't want you, but there's always retail and you can always go on Echo. And I don't know, Kaledora, how do you view these platforms as a founder?
I think, I mean, the timing matters a ton. Like, I think a lot of people probably try to go out exactly what you said. It's totally feast or famine. It's like most things, to be honest. Like, I mean, the world just like almost all things are just they're not like evenly distributed. Like they usually fall like on one end or the other end of the spectrum. So we've thought about it a lot, to be honest. And I think like the timing for when you do one of these sort of like crowd sales and the platform you use and how you want to do it is extremely important. There's also this like kind of unique dynamic that I'm still trying to work through. And I think it's gonna change substantially, where I think the Echo was initially used as this kind of like way to get in a bunch of crypto KOLs after a large VC round. And there's this weird dynamic where like uh in order to some platforms, so you might be right before a large round, or you might be right before your next fundraising round, and you can either have a VC price it and have your round and raise most of it from VCs, but then you have a smaller allocation left over for some sort of crowd sale, and then the expectation typically has been like some discount to the last round. Or if you give a larger allocation, maybe the time between your last round, round one and round two, you 3x'd. So if you try to majority raise through sort of like crowdfunding, maybe you're trying to give you'd wind up at the same price. So you're going to do a price midway between round one and round two for the, let's say, the Echo sale. But people will see that there'll be a negative perception because you're doing it before the next round. And so people think, well, how, this is so unfair. You're not giving the community the right to, you're raising at a higher valuation than the last round. Meanwhile, like, you couldn't possibly raise that amount of money at the last round valuation. You would be insanely diluted. So, and you'd have like a very unfavorable token pie, let's say. Whereas, then the expectation is people want a discount. So then you kind of have to go out and raise regardless and have someone institutional put a price on the thing and then offer this discount. And then you sort of like pay the perception game better, but then you can only offer so much. Well, one, because you're expected to have to give a discount. And then two, you've given up the majority of the round to sort of a set of institutional investors. And so there's less left over. So there's these, I think as with all
you can't
things,
win, is what you're saying.
Yeah. Well, look, you can play both sides so you come out on top. That's the answer. You can always win. There's always, you can always win. So, but you have to be very strategic, I think, about when you do it. And so I think, yeah, I mean, it's like, if you're, I suppose, naive as a founder, you can perceive it as like some panacea, like, nobody, as you said, like nobody wants you, but like you can totally go out and raise crowdfunding. That's just like simply not the case. Like all the winnings tend to aggregate to the top. So you need to
The problem is that it was once the case, right? Like there were moments in time when absolute dog shit products were raising a lot of money. And yes. You're right, it's gone. That window passed.
That's also a different story, like dog shit product versus like dog shit narrative. Those are two different things. You can have a pretty bad product and a great narrative. So yeah, many such cases. So I'm less product side entirely aside. I'm talking more so sort of like building up public perception and hype around like the perceived valuation of what you're building. Yeah, it's a very, for better or for worse, I think because people largely fail to understand sort of the general, like maybe like round mechanics or how dilution works and those sorts of things and what's going on behind the scenes. There's a lot of crafting that winds up needing to go into like the precise time at which companies, even with, I mean, with Mega, you guys are clearly much more the experts on Mega than I am as investors, but they bought back some of the equity prior, which was, I think, it was a very interesting choice from like a signaling perspective, and then went out and did this crowdfund. So those sorts of, yeah, it's another tool in a toolkit, and I can totally understand why Coinbase is investing massively, because I mean this is kind of somewhat the original promise of crypto in some way. There are a lot of different sort of parallel promises of crypto and narratives that got people to buy in the first place. But I remember when I was first trying to convince, I don't know, my grandpa that like there was some value in try to explain crypto. One of the examples I used was like network, the early users of a product being able to be owners of it. All these guys, all these drivers. This was the example I used with my grandpa. On Uber, it's so unfair because all of these drivers who helped build out the network, and you wouldn't have Uber be what it is today if these drivers didn't exist. They didn't invest early on. They never saw any upside beyond just what they got paid. They should be able to, and that's more related to like rewarding network participants. But what if they had been allowed? What if based on hitting the criteria of being a driver for Uber, they had been allowed to invest or had been allowed to earn a share of it? Like that is, I think, very core to the initial promise of crypto. And it's often what I found when I'm trying to convince normies, for lack of a better word, is one of the things that people find most convincing.
So it is very compelling.
Yeah.
Ironically, it has totally failed. Like the story that, okay, you just like airdrop your users and then that's going to create this like aligned community that will never abandon you. We've seen in real time how that narrative has completely just evaporated. And we've seen a reversion now to the ICO meta, right? And that's exactly what Echo plays into, is that, okay, the airdrop meta is dead. Like it's all farmed. It's all kind of these bullshit artists who will pretend to be aligned with you until your token goes down and then they'll tell you how terrible you are. And the real thing that you want is economic alignment. You want a big mass of investors who are all going to care about you. So, to your point about Mega ETH right now is raising, I guess, their last ICO, because they did multiple pre-ICO or pre-TGE raises. This is their last public raise. And they're raising at $1 billion valuation, selling, was it 50 million? I think they're selling. Yeah. And there's over $1 billion in interest that registered for this particular sale.
Nuts.
And the way the mechanics of the sale work, so it's like, I think it's like, what is 16x oversubscribed or something like that?
Yeah. 25x last time I checked, 25.4.
Oh, I'm sorry, you're right. Yeah, 27x oversubscribed.
Yeah.
And so the way, my understanding is that in this sale, the mechanic is that they basically decide how to clear the market. So it's not just, okay, we divide up by everybody gets 1/27th of what they asked for. We're going to look at who you are, what you did. We're going to try to figure out if you're sibling or like signing up all your grandparents to like join because you have to KYC in order to participate in this ICO. And they're basically going to decide how aligned you are before they give you an allocation.
Which I also think is fair. I
totally think it's fair.
Something I've thought a lot about, I think it's maybe kind of more like an open question, is like, it's very unclear what the optimal sort of like Gini coefficient of like ownership of some supply of ownership in like a token or a company is. Like because I think some of the promise, or like initially, I think the way people were using Echo was like, I got to get all the KOLs on Twitter to like say nice things about me. So I'm going to give them all like a tiny, throw them a tiny bone, right? And then they're going to say nice things. The problem is like, if you don't have enough skin in the game, and you guys certainly know this as investors, like if you don't have enough skin in the game, you simply don't care. You're going to be more mercenary. You have to people only really value things that they've invested like capital or effort into. And so if you make it, if you raise a massive round, you give like a 70% discount to your round, you open your, Echo, everyone and their mother is in, it's just like, you're not really creating alignment. Like there's a lot of other things that go into it. And like, it's probably better to have, whatever, like you're selling 10% of your company, maybe the optimal setup is like 10 investors with 1% each rather than like 10,000 investors. So I think, I don't know. I don't really have an answer, but it's a very interesting question. I was like analyzing the other day, like what was the split among like at Hype TGE? I was very curious, and I was looking at a couple different TGEs. Like what was the split of this again, like the kind of Gini coefficient of ownership? It's it's a very thorny question. It kind of depends on the product. It depends on the market too. But like max distribution is like not always necessarily optimal. Obviously, a high level of concentration is not, which is sort of what you see in the VC world. Like I think we like went probably too far with like purely private capital raises and a very high concentration among a small number of people. Then there's sort of like, and you wound up with this like super skewed thing where you had like, people largely raised through VCs. It'd be super concentrated. Then you do this tiny echo round where everyone's putting in like $1,000, right? You kind of, I think you need more of a middle class. And I think that's like what what I see, I think Mega ETH like aspiring to, and I hope they achieve it through this ability to like solicit all of the demand and then ultimately make the call on who gets a piece of it. Though they did cap it, to be fair. I would be very curious to know like why they capped it at like 182,000 per person, because I would imagine like more of a middle class, you might want a higher cap or different ranks. Like you could have different tranches. Some commit that was like a and then the big jump between the tranches, like minimum 10K up to 100K. And then you can have a tranche that's like 500K to 2 million, and you can kind of then architect these like different tranches based on what you want the composition of your sort of cap table, whatever token cap table you want to call it, to look like.
Tom, what's your take here?
No, really good points, and I think I agree with a lot of it. I've kind of discussed this with Mega ETH and other teams that are going through this process of like, yeah, you don't want to just pro rata distribute tokens to everyone based on who ended up bidding the clearing price, because then, like you said, it's do I care about $1,000 position? No, I'm just going to yeet it and like move on to the next one. Like you actually want real skin in the game. And then part of that also is like, who is this investor? What have they done? Are they willing to lock? Like, is this sizable for them? It's really like this kind of multi-variable auction at the end of the day. I in some ways, I was kind of, it kind of reminds me a little bit of like the art market or like luxury goods market, where it's like, you can't just walk into a gallery, like a high-end gallery, and be like, I want this piece of art. They have to like, they're going to vet you and figure out, okay, are you a person who buys and then flips in the auction? If you do, you're banned. You can't buy this art. Or are you someone who has previously, bought really nice stuff and is kind of a tastemaker? Okay, then you can actually buy it. And there's kind of this like vetting of the people to make sure that like, okay, you're going to be a long-term appreciator and holder, and you're going to bring some sort of like aura to the brand. And I feel like maybe like token projects are also going through kind of a similar sort of phase.
Wait, so okay, hold on. So I want to delve into this analogy here because this is very interesting to me. Okay, I understand this for let's say you're whatever, a high-end beauty brand, right? And it's like, okay, we want to engender a certain vibe about the brand and a certain clientele and so on. But if you are an art dealer, that seems different to me. Like in the case of in the case of when you're buying some high-end beauty store, they are giving you like bulk discounts and they're like giving you special favors, and there's like a whole system of pricing that they use to like bring you in and make you feel like you're being treated in a special way. Whereas when you go into an art gallery, it's like, okay, were you going to buy this $25 million piece of art? Like if you're going to go flip it, like why does the art dealer care?
It doesn't work like that. Like literally, you could go into a gallery in New York and be like, I want to pay full freight for this piece of work, and they're just not going to give it to you.
But because, like, why?
A lot of it is
it's like the Birkin bag. You can't buy the Birkin bag.
Birkin bag or Rolex. It's very reflexive, right? It's how do we sort of ultimately, a lot of this also is about like,
is because they own the stock of that particular artist. So it's like for that artist.
Yes,
they are trying to make sure that the
price
artist
of the art yes, they basically want to sell a floor price. And
that is the job of the gallery.
Right.
And it's also who you are, right? Like if you're someone who has a history of buying great art and creating a track record and like being a socialite in some way, great, you're more likely to be able to be approved to, buy, a really nice watch or a Birkin or a piece of art versus some Joe Schmo who comes in off the street. And so I think because of it is kind of manufactured in some ways, like that is also why there's all these sort of touch points around who gets to buy this piece of art or whatever the item actually is.
The reason the galleries take like a 50% cut.
But the difference here, of course, is that these are both examples of whether it's like the Hermes bag or whether it's the emerging new artists at the fancy gallery, is that these are, one, limited supply and they're positional goods, right? So like these are things that are valuable because of their scarcity and because of who owns them. Whereas, Mega ETH tokens, like the reason why it's valuable to be in the ICO is because everybody knows the clearing price is below the fair market value. Right.
Yeah, and
which
if you're buying,
quite different.
No. If you're buying, like again, let's say a Rolex today, that's like an in-demand model. The retail price that you're buying at is like way below what it's selling for on the secondary market, right? So you're also effectively getting a giveaway. I think the point in all of these practices is to like encourage the appreciation of the price of these items over time. There are a lot of things that are rare or like scarce that aren't super valuable or that don't necessarily go up over time. But here it's basically like it's sort of an artificial scarcity, but then also placed with people who aren't just going to go sell and also create induce demand for the item over time. And so it's sort of like, yeah, I'm only going to sell to people who are promised to lock it away in a vault forever. I'm like, great. That's actually like, if you care about the appreciation of the assets that you sell over time, those are like the best buyers you can have. And so that's also why you kind of get the free port system.
So you think it's a one-to-one analogy?
It's not one-to-one. I mean, it's certainly there's like a sort of soft component to it, but like ultimately it's like with any of these sales, it's like you're basically giving away some value, and the trade-off is that you want to give it to people who are going to be good stewards of the asset to make sure that, hey, this thing isn't going to get sold immediately. It's sort of like long-term capital, right? Like, why does someone raise from a VC or PE fund versus just like going to the market? It's like, yeah, because this is long-term patient capital that's going to be there to sort of support the thing, which is how you create value and sort of price appreciation over time. And so I'd say more similar in that way versus I don't know.
Hold on. There's a difference though between the exclusivity of the holder base, right? Which is like what it is. So there's holding period and then there's exclusivity.
Yes.
Maximizing just for holding period is different from maximizing for, I only want really cool people who are extremely refined.
That's how you define cool.
Yeah, it's multivariable, right? Like, if you are extremely cool, your sort of effective price maybe goes down, even if you occasionally sell in your sec art, on an auction. But hey, if you're not super cool, but you are a storied collector and you never sell anything, then maybe that sort of increases sort of your effective value that you provide. So it's like it is multiple things sort of triangulating to what is your actual bid on this item.
What I was going to say on this is like it's a lot of it's just like it's about creating artificial scarcity. I was thinking, just not to bring this up again, but just thinking because I was looking at the numbers specifically on the Hype TG and looking at a few other ones, and they're like, I think it really played in their favor that you couldn't buy it on any centralized exchange, because and that's only the case. Okay, it's kind of like inflating the money supply. Is it could be like deflationary or like inflationary. 2008, everybody was concerned things would get super inflationary. We're like pumping money in the economy, and actually like it became a little bit more deflationary. So it basically what you're adding is you're adding something to the system that can create a reflexive loop, but it can go one way or the other. If you create scarcity, if not enough people care about it, you actually can deflate the value. Like if not enough people care, they can't buy your token. It's like, obviously, most token launches that don't get listed on like Bybit, Binance, OKX, whatever, it's a sign that they're going to go poorly. But in that case, there was enough of a reflexive loop that was pushing things upwards that I actually think it was a huge benefit to them. Because I don't know how you guys felt at the time, but it was honestly to me, it's funny we're talking about this now. I was reflecting on it yesterday. It almost felt like a luxury good. You had to like bridge to this like new chain. You had to like go to this like new exchange to like go and buy the token. There was like one place you can get it. Like it was kind of hard to get. And I really think that played in their favor. And there was a small number of very fervent supporters talking about it, but not that many people got the airdrop. It was like, most people didn't approve the thing in their blah, blah, blah. It was like 5,000-6,000 people got like something actually meaningful. And that was like, but it was really life-changing for them. And so it created this like incredible mystique and hype around the few people who had access, in the same way that like, you own a Birkin bag and it's like, holy crap, like this really cool person owns it. Like, it was really valuable for the few people who had it. But then there was this sort of like artificial barrier of scarcity that massively, I think, like increased the sort of like mystique and demand for this thing. And I think like similarly, I was thinking about this in relation, and by the way, like we're talking about ICOs, like, how they run an IPO, right? You like go around, there's a roadshow, and you go and you're trying to build your book, and you figure out, and they love to ask you exactly how much is available. People, VCs do this too, right? Like how much is available in the round. You actually should not tell people exactly how much is available, because when you do it, then you're cornering people into being like, okay, I'm taking 5 more checks of like 250 or whatever. It's just like, you don't know actually. Like I don't know. It like depends on how much conviction you show. It depends on how much you say you want to put in. What's the optimal amount? What is your target amount you want to put in? And then I can take that back and look at it, and then we'll close the books and we'll decide. And like that is what they do in an IPO. And I think that's generally what you should do as a founder when you're fundraising. And I think that's what you should do through like an ICO. Obviously, there's going to be a lot more people. You're going to be able to be a little bit less considered. You have to be more programmatic about it. It's going to be less vibes based. But my view has always been like, if you're trying to close the last 5 million or whatever it is, like in a round, rather than saying like, okay, I can only take 1 million, you've pre-allocated ahead of time, people should tell you, give me a range. Like, what is your desired out? What is the max amount you would want? What is the minimum that it makes sense for you to have enough skin in the game? And then you collect all of that. You're like, all right, final numbers are in. I've closed the books. And then you decide and you allocate at your own discretion according to who you think ultimately is going to be the best steward of the equity of your company. And I think like that is the process that's used in IPOs that works. And that's how it should work. Like you should and I think like, yeah, these platforms are really just go back to the core topic. Like there's a few things that have been tried. There's been the like get as many people as possible to put in $1,000. I don't think that's the way. The way that you maximize, you get more out of like if you can fill out $1 million in any way, you want to fill it out in the best way possible. That's going to go towards the people who are going to be the best steward of your capital and treat your company and treat your token like a luxury good. Because if you really believe in it, it is.
All right, we're running up on time, but I want to get Tarun's take on the luxury goods ICO question. Tarun, what is your take as the sort of chief scientist of the podcast?
Having sold a couple art pieces, I at least have some idea of like the other side of the market of like what the value a gallery gives you is. And I would say there's something that's kind of Tom hinted at, but I think like you're kind of missing here, which is not really true for token launches. But generally the history of the buyer is extremely important in the art world. Not even just the history of it being an individual, but like there are artists who will only sell to institutions that have like a certain set of criteria met, right? Like it's an institution that's young. I won't sell to MoMA because fuck them. They're too like old people go there. Like that, there is stuff like that. That's constraints that like the artists actually place, which is like the equivalent here. And a lot of those are path dependent.
This conversation is making me feel like a pleb. I just want to say that.
They're very like path dependent. Like you care about like the entire history. You definitely and whereas like in the pseudonymous world, the path dependence is like purposely broken, right? Like it's like I'm purposely trying to hide as much as possible as I go into the airdrop. So there's like a little bit of like a weird trade-off there. Like I know that like the protocol developers would love to force revelation, like force the users to disclose something about themselves. But realistically,
I think they are, right?
They're forcing some stuff, but it's like you don't know their whole provenance, right? Like you don't.
Do they not have you connect other stuff?
Yeah, they have like I think Twitter or Telegram or something like that.
You connect your socials and stuff. And
I think you can do it even better. You can see your whole on-chain transaction history. You know, you could have another wallet where you're dumping stuff.
Yeah, why would I ever reveal a wallet that actually is like...
People are surprisingly unsophisticated about this stuff, I feel like. And like you're either like a industrial farmer or you're just single account.
My favorite thing is watching
ENS.
all the hyperliquid airdrop farmers who never used crypto before, like suddenly realize everyone could watch all their trades and front run them. Because like there is that aspect, but I do think like the people who you want as sort of stewards or whatever, like your criteria is going to have to take a lot of factors in. And I think the art world is kind of weird in that the next sale price is completely determined by the entire history of holders in the past. And I'm not sure that's, I think that's what NFTs were trying to get at, but they obviously didn't really work out. Whereas like, I definitely don't think that's true for tokens, especially tokens with yield, like staking tokens. Like why is that true? Like eventually that goes away. And like, you've seen that with all of them, that doesn't matter.
All right, Tom, I'll give you the last word here before we close out.
I don't know what the last word is here. I do think, the history of crypto is someone invents something new, some experiment. It works extremely well. And then everyone just copies them until all the alpha is gone and the strategy is exhausted, and then we're on to the next thing. And I actually think we are on the cusp of something happening in ICOs. I think this mega ETH style, reveal me your true bid, show me your true colors, and I will sort of place allocation where I see fit, feels like the way things are going.
You mean it's the sorting hat?
It's the sorting hat. Yes,
that's like basically what.
It's
as
the
opposed
bouncer.
To an auction. It's a sorting hat.
Yes.
Yeah.
But to Kaledora's point, like this is in some ways crypto also relearning the lessons of TradFi, and like maybe some things were good, and overall I'm just like it feels like the sophistication of capital allocation is just getting higher and higher. So
got it. Okay, well that's all the time that we have. Kaledora, thank you for joining us. Where can people find you, and what do you want to plug?
Thanks for having me, guys. You can find me on Twitter and Telegram. I'm at Kaledora everywhere. Just my first name, Kaledora. And yeah, come to Ostium. We have the most predictable and stable funding rates and deepest liquidity on stocks, indices, metals, energy, FX. So really any TradFi asset you want to trade, we are far and away the most liquid and the best place to do that. We got a lot of people trading Google, Apple, Amazon, NASDAQ, and even weird indices like the Hang Seng Index if you want to, bet on the Chinese market indirectly. So yeah, come try it and give me feedback. If you don't like it, message me, DMs, and I will.
If you don't like it, roast her on Twitter.
If you don't like it, message me and we'll fix it. I can promise you that.
Okay, great. All right, we'll be back next week. Thank you, everybody.
Cool. Thank you
See
for
you
having
next
me. Ciao.